Hey guys, I want to make a quick video essentially about how markets move. And this is going to be a very simple base level explanation, but the reason I'm making this video is because a lot of fake trading gurus on YouTube have completely screwed up a lot of people's thinking about trading. And this was the case for me a few years ago too, until I really kind of just sat back and assessed logic and was like, okay, and if you don't know who I'm talking about, it's mainly ICT, right? Just like everyone else, I tried to trade ICT for over a year and it doesn't work. But I'm really glad that ICT exists, because once I realized that he's a fraud, it was able to confirm to me a lot of the ways that the market actually works. Okay, and so I could debunk ICT, and say that like fair value gaps don't work. First and foremost, that's like the first thing, which is the reason fair value gaps don't work is because candlesticks are illusory. ILLUSORY. If you don't know what that word is, look it up. They're illusory because they're not a completely accurate representation of how price moves. And I've talked about this in older videos, but I haven't touched on it in a while. But basically, it just tells you the open, high, low, close. It doesn't tell you how it got there, right? Now, obviously, the lower the time frame you go on, the easier it is to guess how the candle was formed. But that's still not a guarantee that you know exactly how the candle was formed. The only way to know how a candle is actually formed would be to watch it live, A, or B, compare a chart of that candlesticks with the same asset, a tick chart, and see how price exactly moved during that 1 minute or that 5 minutes of time, comparing on the tick chart. Then you would know, because technically two candles could exist that look exactly the same. Like you could have two candles that look exactly like this green one, right? And technically the way that they form could be completely different, right? They just would both open here and close here, but maybe one could open, go up, go down to the bottom, go up, and then close, and the other one could open, go down, go up, trend its way up, and then close, right? And there's like theoretically, if you're looking down to the tick, almost an infinite number of ways that a candle could form, even two candles that look identical, right? So that alone debunks ICT, because there's no imbalance there's no imbalance left behind by a candle, right? The imbalances are moment by moment, and they're based on the depth of market, which is just how many resting orders are above and below price at any given time. People can pull those orders whenever they want. People can add to those orders whenever they want. And just because, like, for example, here, there's no red in that candle, first off, doesn't mean that there was no selling during the formation of that candle. It could have gone up, then sold off, then gone up and closed, right? Or it maybe didn't. But there's no guarantee that in either case that means that there's like an imbalance there and price is going to reject when it goes back into there. Obviously, you can see here it happened to go up a bit after entering there, but there's plenty of, I'm not going to take the time with that because this is kind of a little bit off topic from what I'm going to try to get at, but you can find just as many instances where a fair value gap doesn't work as where it does work. Because really, just like any other point in price, generally speaking, it's usually 50-50 of whether it's going to go up and down. And so you'll find 50% of the time a fair value gap, quote unquote, works, and half of the time it doesn't, which means that there's no edge there. And it's really just because price has basically no respect for something like that when it returns to that area, if it does. Anyway. Kind of a tangent, but anyway, back to my main point. How does a market actually move then? How does price move? Because people, someone like ICT talks about liquidity sweeps and stuff like that, which they do occur in some sense of the word, but again, like I said, people can pull or add orders whenever they want. So liquidity is a lot more variable than just, this high or this low. Like sometimes price will go past a major high and then reject right away. Other times it'll just blow right through it again. So it's like kind of hard to be like, you just look above old highs and below old lows for liquidity sweeps. Well, not exactly, okay? Because if you understand standard deviations and mean reversion, like those types of things have a lot to do with why price would reject after going past an old high. It doesn't have as much to do with the liquidity sweep as you might think. Now, maybe there's some times where it does, but again, you wouldn't really be able to know that very easily. So anyway, what causes price to move? This is the simplest thing about trading that you need to remember all the time, okay? Where is a arrow? Okay, so if buyers exceed sellers, price goes up. And why does it go up? Because let's just say, I don't have a depth of market right here, but let's just say every price tick, there's a depth of market. Let's say right at this tick, which you can see over here, let's say right at this tick, there's like 10 buy orders, but there's only 5 sell orders. Well, guess what's going to happen? 5 of those buy orders are going to get matched to 5 of those sell orders, and then the other 5 buy orders that exceed those 5 sell orders are going to move up to the next tick if they're market orders, and they're going to find sellers there, right? And that's just the very basic explanation of it. But basically every single moment, that's what's happening, is there's a constant excess of buyers, excess of sellers, and price is constantly fluctuating based on that imbalances, right? If price was always at a constant balance of exactly the same buyers and sellers, price wouldn't move at all, because every order would be met at that exact price and price would stay the same, right? But there's constantly a constant, ever-changing amount of buyers and sellers at every single price level. And where it's meeting in the middle is the price, the agreed upon price right there. But as soon as there's an imbalance to one side, which will be like less than a second later, it's gonna move in the direction where the imbalance is, and then it's gonna be constantly fluctuating as it's constantly imbalanced, right? It's never really imbalanced. There's always going to be slightly more sellers or slightly more buyers at any given tick level, which is the exact reason price moves. Okay, so just try to wrap your head around what I just said, because that is the complete reason why price moves on anything tradable. And I can prove it to you as well, because have you ever heard of a pump and dump? This has become very popular with cryptocurrencies, pump and dump scams. But before, it was penny stocks and the OTC stocks, stuff like that, where a scam company, or lately a scam cryptocurrency, like a token or whatever. I don't do a lot of research on crypto, so I don't know the nuances of token versus coin, all that, whatever. Listen, the point is, someone will make a scam token. They'll release it onto the market while they still hold the majority of the supply, correct? So they have most of the price, or they have most of the market cap of that crypto, and then other people will step in and start buying it. They'll buy it. It might buy, it might sell, but it'll kind of fluctuate. But price will tend to go up because they usually promote it on Twitter and on TikTok or on any sort of social media. It could be Reddit, could be whatever. Could even be like 4chan. I don't know. I don't go on 4chan, but they just find a place to promote the coin where they find willing buyers to enter into the market and buy up more of the market cap of that crypto to bring the price up higher. Once the price has gotten to a desirable level for the creator of the token, they begin doing what? Selling off their supply of the token. And seeing as they have the majority of the supply, them basically market ordering or even just limit ordering, but it's going to keep driving price down, right? Because there's going to be an excess of sellers because they have most of the supply, and as they dump that supply onto the market, it's going to absorb all those buyers and then start taking them down, and price will then subsequently drop to basically zero, right? Because as soon as the supplier has determined that they have enough to sell, they'll just sell all of their supply, and they basically make the difference from where they opened, what the price that the essentially original opening price of the crypto from the very moment it became tradable to the high. They'll make the difference in the amount of dollars that it took from all the cumulative other buyers who get scammed to drive the price from its original price point up to the high. Now, it can get more complicated than that, where the original supplier will even help buy up some of the supply to keep driving the price up as well, to make it more appealing to buyers who want to FOMO in, right? Not saying they always do that. They actually don't do that often. But when you get to the real stock market, that kind of stuff does happen. Essentially, institutions will sacrifice profit just to drive price up a bit to try to get more buyers to be like, oh, this is moving up. And then more people will pile in on the trade, right? That's kind of how the way that you can manipulate price on an asset that you don't have the entire market cap for. Anyway, that's getting more deeply nuanced. I'm not talking about that because I know that I've seen an institution do that. I'm just saying I can. It's pretty reasonable to kind of assume that that's part of the game that big institutions play, right? Where they try to buy up price to make it look appealing, and then people pile in on and drive it up even higher, and then the institution will dump their shares to those late buyers, right? Or if they're shorting, it's the inverse. If they're selling it down, then other people pile in buying puts or short selling calls, stuff like that. And then once there's enough liquidity for them to stand to make a significant profit as their massive position going against all those people who got baited in drives price back up in this short selling scenario. If they start rebuying their shorts back up, it's going to drive price back up. So they won't get the same price on their whole position. As they unload their position, they cumulatively start to get a worse and worse deal on the remaining portion of their position, right? Or if they're buying and they're selling it off, as they sell off their position and there's less and less buyers to buy up their position, price will go down and they'll get a worse and worse deal on the remainder of their position that's in profit. Anyway, I hope what I'm saying here makes sense. I know I didn't kind of visually draw it out as I was saying it. I'm not the best at that. I'll try to be better about that, but I think it's more important if you can just hear what I'm saying and try to visually picture that yourself. But again, with the crypto pump and dump thing, price gets bought up by the people that they convince, oh, it's going to go to the moon. And then those people will see it start to move up and they'll be like, oh, it's actually going to the moon. And so it becomes self-fulfilling. So then they buy, but then they're told to hold. They're told to hodl, right? To hold. And then by the time they realize what's happening, it's too late because the original creator of the token dumps off their entire supply into the market and it crashes the price to basically zero, right? And then that original creator of the token makes the difference, right? All those people that bought the coin, their investment goes to zero and they make the difference, right? That's literally how trading works, and that's the game you're trying to play. It's a zero-sum game. You're making the difference between other players' losses, right? From where their entry is to their loss. It doesn't mean it's one-to-one. You might buy from one person and then sell to another person, but in a roundabout way, all the cumulative wins from the market balance out with all the cumulative losses from the market. So if you make money trading, that literally essentially came out of somebody else's account, right? Or maybe, part of it came from one person's account, part of it came from another person's account, which is more likely to be what the actual scenario is. But if you're doing options, then it's a match one-to-one. Well, I mean, it's still, again, you might have bought the option from one person, you sell it to another. But again, if someone gets assigned an option on you, they get assigned for that full option. But I mean, if you have multiple contracts, one person might have got assigned part of your position, depending on how many contracts they get assigned versus, another person. Anyway, I don't really do options, but again, it's the same concept. Options are pretty similar actually to stocks. They're just made to be overly convoluted and stuff to try to entice people in. Knowing options doesn't give you a whole lot of an edge. It just makes trading a whole lot more complicated unnecessarily. But yeah, anyway, this video ended up being a little bit longer than I expected, but it's really simple. Excess of buyers drives price up, excess of sellers drives price down. It really is supply and demand. Okay, but that doesn't mean I'm not saying trade those quote unquote supply and demand zones, because those are even more fraudulent than ICT. But it's supply and demand in terms of every moment by moment price fluctuation is a representation of an excess of supply or excess of demand and the market reacting to that. So It's really important that whenever you're trading that you keep that in mind, because that is really the basic reason for all of how the market works is built on that basic building block. Fundamental price is either finding an excess of buyers or an excess of sellers. And it's never going to be perfectly perfect in equilibrium, right? It's always going to be slightly imbalanced. Now, obviously, you move to the higher time frame, and those you can find bigger so-called imbalances. But again, predicting how those imbalances occur is where trading gets really hard, and then you have to look into tons of data, and there's so many different avenues you can try to figure out how it happens. But it ultimately comes down to patterns in human behavior, or patterns in the behavior of computers that are programmed by humans and how they work. But again, there's going to be patterns to the imbalances of supply and demand. And your goal as a trader is to figure out how those imbalances can be identified, how they manifest, what are the patterns that tell you there's a especially even on higher time frames, but also on lower time frames. What tells you there really is an excess of buyers or an excess of sellers to such a large degree that it's going to move price violently? Seeing that ahead of time is extremely difficult, right? Now, it doesn't mean that the only way to make money trading is being able to identify that. The way to make money in trading is to identify a pattern of any sort, whether or not you understand that. However, understanding that fundamental building block of how markets work and just remembering to bring yourself back to that every time you're getting confused by the markets is going to help you a lot, right? And so that's why they talk about bottoming wicks and stuff like that, topping tails, or bottom tails, or whatever, topping wicks, whatever, however they talk about it. But topping wicks, bottom tails. What occurred here most likely was that price went down it got oversold so much that it actually found a lot of, for whatever reasons, these institutions and their analysts found enough willing buyers at that price level. So most likely this price, because it did open at the high of day and then it sold off and then it bought up to the close. Now, it could have gone boom, 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 boom all day and then finally closed, or it could have just gone down, up. And if we look at that day, we'll get more insight into that. So that was August 5th. Let's see if we can get back to that date. Nope, it won't take me there. I could get to that contract, but I'm not going to waste your time. It's been long enough. This video is long enough. But I hope this is just good food for thought. It's very simple, very basic, but this is so crucial for you to understand if you're going to try to approach the markets. Okay, and so lastly, though, I'll talk about on the biggest time frames. What the hell is this? Why does the market go up in the long run? Well, I've talked about inflation, companies with high growth being weighted the most heavily on this asset, but also being assisted by inflation, because inflation drives up their stock prices. So why does it go up in the long run? Because there's an excess in the long run. There's an excess of demand to supply on this asset, because it's literally money is being created out of thin air and being pumped into the assets that this is a derivative of, right? Essentially. So because this isn't inflation adjusted, this chart is not inflation adjusted. So what you're seeing is literally the effect of money being created out of thin air, devaluing the value of the currency, and inversely pumping up this value. So as more dollars get created out of thin air, this asset gets pumped up higher, essentially, in the most basic form. So that's why you should bet more on the long-term trend of this going up. Now, that said, though, why is there a huge risk of a crash right now? There's a big risk of a crash because, hear me out on this, interest rates are being cut. Okay, and if you want to see, I already did this in my last video, interest rates, okay, when interest rates go down, the market tends to crash. As you can see, interest rates decline, market crashes. As interest rates bottom out, market starts to pump again. Interest rates decline as market's crashing. Interest rates bottom out. Now they don't go up, but they bottom out, which means that they can only eventually go higher, right? They can't go any lower, so the market goes up in anticipation of higher rates. Okay, anyway, what's happening there? Okay, well, when interest rates decrease, people say that it makes borrowing more appealing. True, right? However, they're not thinking of the other side of that, which is lending. When interest rates are lower, lending is less appealing. So if banks, and they are doing this, you can look into it, banks are aggressively reducing credit limits on their customers' credit cards as rates go down. Why? Because literally they stand to gain less for the money that they risk by lending out credit or writing loans to customers. It becomes riskier and riskier because the more interest they can collect, the more they can survive the credit defaults that occur from a percentage of their customers, right? So banks know a percentage of their customers are going to default on their credit or default on their loans. They're going to literally just file for bankruptcy for Chapter 7 or whatever, Chapter 11. I don't know all that stuff, but they file for bankruptcy, and then the Wells Fargo or whoever has to write it off, right? Well, if interest rates are lower, yes, it is easier to pay off your debt, but not so much that it's going to have a crazy impact on the default rates. So if they get less money on interest, it's riskier for them to lend. So yes, it's more attractive to borrow, but it's also less attractive to lend. So if it's less attractive to lend, banks are going to reduce credit limits and they're going to lend less money. And remember, when I'm saying lending, I mean like credit creation. So if they're not giving out credit as easily, or they're destroying credit, what have I said about credit and debit? Credit is literally one of the main causes of inflation. Credit literally is inflation, essentially. Until it gets paid off, it inflates currency. But if they reduce your credit limit, they're literally deflating that fake inflated currency. So as they destroy credit and destroy available credit, there's less money that can be spent on the assets that this futures market is a derivative of, which is this is a derivative of the NASDAQ 100, and the NASDAQ 100 is a basket of 100 or 101 big tech stocks. So if people have less credit to spend on the goods and services provided by those big tech companies, this asset has trouble sustaining its high price, and there's less demand, and it's easier for sellers to drive the price down. So I hope you guys are bearing with me on that. I kind of actually went way further than I was expecting to with this video, but I hope that explanation makes this all make sense, because nobody taught me this, by the way. I had to figure this out for my own, but it's pretty logical, right? Like, I just followed a logical conclusion of thinking about these things analytically. And no, I don't have a ton of documents and stuff to back up my claims, but it's kind of self-explanatory. Like, what I'm saying pretty much makes sense that it would be true, right? Like, there's really no other explanation for the market, for the bias of this asset, other than what I'm saying, right? Like, good profit margins companies weighting up this asset when there's inflation, periods of high inflation, that means tons of money gets pumped into this market. And when there's deflation or disinflation, the market can't pump as hard, and actually it's easier for short sellers to get out, or to drive price down. But also it's people will start to realize, and especially like big institutions, as they see disinflation occurring and even some mild amounts of deflation, they will start to sell off their position, and they'll because they expect it to not yield as good, right? So they're going to sell part of their positions and look for things that are going to increase more quickly, which probably honestly could be crypto. Like, I think Bitcoin actually could run a lot as people move out of this asset and into crypto until interest rates hit a bottom. But whatever they move into, they're going to move into something, right? But it's interesting how it works like that. I don't know. You can disagree with me if you want. Feel free. We can have a debate about it in the comments, or you can come into my Discord and debate it. But I think what I'm saying really does make quite a lot of sense if you really think about it. So anyway, sorry that this video got to be way too long, but I hope you stayed tuned for the whole thing, because this is really going to help you understand the markets. And by the way, again, I figured this out on my own, and I'm not trying to toot my own horn, but you can go through an entire business school, university education, climb up through a corporate ladder, work in finance or accounting or in some sort of business that works around money management. You could never understand these things, because the whole system never will. I mean, again, I haven't been up, I don't work in finance, but my guess is that the system does not promote awareness of what I'm teaching, because if it did, then everyone would know it and everyone would piggyback on that play. And the people who, the wealthiest people who make the most money off of what I'm explaining to you, it is completely against their best interest for people to be aware of this stuff. So you could try to your hardest and go get a crazy good education and climb your way up through a corporate ladder and never figure this out, because the whole system is designed to keep this information and knowledge out of your mind. Because once you know it, it becomes very easy in the market. In terms of long-term bias and stuff like that, it becomes very, very easy to trust your gut and on terms of, or trust your knowledge and your understanding of, like, okay, I know when the market's most likely to crash. I know when to start reinvesting into this asset, that kind of thing. I know when, even if you're day trading it or swing trading the stocks that this asset's comprised of, or even stocks that aren't in this derivative exactly or in the NASDAQ, but are adjacent to the stocks that will also, stocks that will perform similarly to the way the ones in the NASDAQ do, or in the S&P, or in the Dow Jones, right? So it's a lot easier to even day trade this asset. If you know that this asset is very likely to crash right now, day trading it to the long side, probably not the smartest idea. Does that mean I'm saying to short it? Not necessarily, because like I said, it still is a long biased asset. So, I think it's going to crash, but it can also get really choppy. So it could get to a point where it's really hard to day trade this, because it's just going to be very volatile to other direction, but it's not really going to pick a side, and it's going to be hard to find a trend to follow, right? Who knows? Or it could just crash really fucking hard, which is, a decent probability of that right now. But again, look, rates cut, markets crash. Okay, you've seen it time and time again. Go look at the history. It happens pretty much every single time. Whenever there's rate cuts, it's either during the middle of or near the beginning of a market crash. So I'd just be on the lookout for lower prices on this. And I'm a perma bull, but like I'm telling you, there's time and place for this thing to crash, and it looks like it's right here. Okay, so anyway, take care, guys. See you next time.